Imagine two twin corporations. They build the exact same products, pay the exact same manufacturing expenses, and generate the exact same revenue. At the end of the year, their bank accounts hold identical amounts of cash. But when they publish their financial reports, the numbers contradict each other. This flow diagram illustrates the paradox. Identical streams of cash enter both companies, yet one outputs a healthy $50 million profit, while the other reports a $20 million loss. You might assume someone is cooking the books, but these statements have been heavily audited. Every decimal point is accurate, and the math is entirely legal. The discrepancy exists because a company's financial reality is not an absolute mathematical truth. It is a translation, dictated entirely by the local accounting rulebook used to measure it. In the United States, that rulebook is maintained by the Financial Accounting Standards Board. They govern the U.S. Generally Accepted Accounting Principles, better known as US GAAP. Outside the U.S., the International Accounting Standards Board controls the framework. They publish the International Financial Reporting Standards, or IFRS, which are used across more than 140 jurisdictions. To test these two frameworks, we are going to track two fictional companies. Aerotech Global is headquartered in London and governed by IFRS. Its identical twin, Aerotech US, sits in New York and strictly follows US GAAP. By watching both companies navigate the exact same volatile fiscal year, we can see exactly how the rules of accounting dictate corporate survival. In the first quarter, an economic shock hits the supply chain. The cost to manufacture the microchips for their drones suddenly skyrockets. This cost flow model shows how Aerotech US handles the price spike. Under US GAAP, they are allowed to use a method called LIFO, last in, first out. The newest, most expensive inventory blocks are pushed straight into the cost of goods sold pipeline. This intentionally shrinks their reported profit margin, which lowers their tax bill. Over in London, IFRS explicitly bans the LIFO method. Aerotech Global is forced to use FIFO, first in, first out. They must route their older, low-cost inventory through the pipeline first, forcing their reported profit margin to remain high, regardless of the recent price spikes. Months later, the market crashes. The raw components drop in value to well below what the companies paid for them, forcing both twins to take an inventory write-down. Looking at this side-by-side chart, we can see what happens during the recovery phase when component values bounce back. IFRS mandates that companies reverse previous write-downs. The London company's inventory value drops, but then violently shoots back up, pulling their gross margins up with it. US GAAP strictly prohibits reversing a write-down. Once Aerotech US tis to hate, their asset value drops and remains permanently locked at the bottom. A massive gap opens up between the two balance sheets. US GAAP enforces strict one-way conservatism, keeping recovered value hidden from investors until the product is finally sold. IFRS injects volatility into the balance sheet, adjusting the numbers up and down to reflect real-time economic reality. In Q3, both companies take a $20 million gamble to develop a revolutionary new drone prototype. Research and development is inherently risky. Because future success is uncertain, US GAAP requires Aerotech US to immediately record that entire $20 million spend as an expense. Their net income for the quarter takes a devastating hit. This split-screen flow shows the IFRS alternative. Once the London team proves technical feasibility, they are allowed to capitalize those development costs. The $20 million avoids the expense column entirely, transforms into a solid asset, and moves directly onto their balance sheet. This single rule dictates how the market perceives innovation. GAAP portrays R&D spending as a severe financial bleed. IFRS portrays the exact same spending as the creation of corporate wealth. By the fourth quarter, a massive commercial real estate boom sweeps the market. The identical factory buildings owned by both companies instantly double in value. Aerotech US cannot claim this sudden wealth. US GAAP adheres to the cost model, forcing them to ignore the boom and keep the factory valued exactly at its historical purchase price, minus depreciation. This isometric diagram illustrates the IFRS reevaluation model. Aerotech Global is allowed to mark the factory up to its new fair market value. The asset physically scales up on their books, pushing their shareholder equity meter to maximum capacity. The two frameworks do agree on certain core functions. When it comes time to actually recognize the revenue from selling the finished drones, international bodies have converged the rules, ensuring a sale in New York is recorded similarly to a sale in London. The physical act of transferring a product to a customer is universal, but the reported value of the infrastructure, the inventory, and the ideas used to create it remains completely subjective, entirely dependent on geography. The fiscal year ends. Aerotech Global appears to be an incredibly profitable juggernaut resting on a massive asset base. Aerotech US looks like a lean, less profitable, highly conservative operation. They ran the exact same business, but generated two distinct realities. US GAAP is built on strict, rules-based enforcement. It prioritizes historical consistency, employing rigid guardrails to prevent companies from artificially inflating their worth. IFRS relies on a principles-based system. It places a higher degree of trust in the professional judgment of accountants, allowing them to continually adjust numbers to build a faithful, real-time economic picture. Neither framework represents an absolute mathematical truth. They are simply different languages describing the same reality. In a globalized market, reading the numbers isn't enough. You have to know which language the numbers are speaking.